They said it was the future of finance. No banks, no middlemen, just freedom, trust, and high returns. Unbank yourself, the ad said. Earn passive income safely, as much as 10, even 12%, just by holding your crypto with them. It sounded revolutionary, and millions believed it. From small investors putting in their life savings to retirees looking for steady income, Celsius promised security in a risky world. But in June 2022, the dream collapsed. Celsius suddenly froze all withdrawals, billions of dollars were trapped, and within weeks the company filed for bankruptcy, leaving hundreds of thousands of users with nothing. This is the story of how one company built trust, broke it, and became one of the biggest collapses in crypto history. This is the rise and fall of Celsius. Our story begins with one man, Alex Mashinsky, a tech entrepreneur with a big personality and an even bigger vision. He'd already made millions in the telecom industry and liked to present himself as a genius, someone who could challenge the entire banking system. In 2017, he launched Celsius Network, a crypto lending platform that promised to put power back in the hands of the people. Here's how it worked. You deposited your crypto, Bitcoin, Ethereum, whatever you owned. Celsius would lend it to traders and institutions. In return, you earned high interest, much higher than any normal bank could offer. Mashinsky said Celsius was doing what banks should have been doing all along, helping the community. He became a social media star, streaming weekly AMAs, Ask Mashinsky Anything, where he promised safety, transparency, and freedom from Wall Street greed. And people loved it. By 2021, Celsius had over 1.7 million users and managed more than $25 billion in assets. It looked unstoppable, but behind the scenes, cracks were already forming. Celsius marketed itself as low risk, even safer than a bank. Mashinsky told users their deposits were protected, that Celsius didn't gamble with funds. But the truth? That's exactly what they were doing. Celsius wasn't a bank, it wasn't regulated like one, and there were no government protections if things went wrong. The company made money by lending and investing user funds, often in risky DeFi projects, trading strategies, and tokens that could swing wildly in value. When the crypto market was booming, it worked beautifully. Profits poured in, everyone got paid. But this model only worked as long as prices went up. When the market started to fall, the entire system began to crumble. When the crypto market crashed in early 2022, everything started to fall apart. Bitcoin lost more than half its value, and the entire Terra Luna ecosystem collapsed overnight, wiping out billions of dollars. For Celsius, it was a nightmare. The company had poured massive amounts of user funds into high-risk investments, including Terra's Anchor protocol, which promised unrealistically high returns. When those bets failed, Celsius began to quietly bleed money. Still, Alex Mashinsky kept telling users that everything was under control.
When the markets are shrinking, when everybody's fear is on, that's just part of the process. Some people hodl and earn yield, and some people decide, you know what, I'm moving to the sidelines, I'm putting money back in my bank or whatever it is. And we've seen that before. Every drawdown is kind of the same thing. And when the markets come down, everybody comes running back. Celsius has billions in liquidity, right? And we provide immediate access to everybody, anyone who needs access to it, right? So real people, real yield, real rewards. Don't listen to the FUD.
He dismissed all warnings as FUD, fear, uncertainty, and doubt, and insisted Celsius was stronger than ever. But behind the scenes, panic was spreading. As customers rushed to withdraw their crypto, Celsius realized it didn't have enough liquid funds to pay them back. So on June 12, 2022, the unthinkable happened. Celsius froze all withdrawals. No one could access their money. Mashinsky claimed it was to stabilize liquidity. Let's take a quick break to thank today's sponsor, The Alchemist, the smart trading assistant that helps you navigate the markets with data, not emotion. Whether you're trading crypto or stocks, The Alchemist watches trends, spots patterns, and automates trades so you stay ahead. No hype, just strategy. Check out the link in the description and use the code CELSIUS for 10% off. Now, let's get back to the fall of Celsius. Freeze sent shockwaves through the entire crypto industry. Within days, Celsius filed for bankruptcy, revealing a $1.2 billion hole in its balance sheet. Court documents showed a shocking picture. Celsius had been lying to users for months about its financial health. It had used new customer deposits to pay old ones, a classic Ponzi structure. Executives had cashed out millions before the collapse, while ordinary investors lost everything. Some had even mortgaged their homes to buy more crypto on Celsius. The company's internal records described massive mismanagement. Funds were used to prop up failing investments. Interest rates were unsustainably high, and risk controls practically non-existent. By the time it all fell apart, Celsius owed billions it could never repay. After the collapse, regulators around the world started digging deeper. In the US, the SEC and FTC launched investigations. Prosecutors accused Mashinsky and other executives of defrauding investors by making false statements and manipulating the value of Celsius's own token, CEL. In 2023, Mashinsky was arrested and charged with fraud, conspiracy, and market manipulation. He denied wrongdoing, but the evidence was clear. Internal emails showed that Celsius knew it was losing money long before the crash, yet continued to advertise itself as safe and profitable. Mashinsky had sold millions of dollars worth of CEL tokens while publicly telling users to hold. It was deception at the highest level. As one US prosecutor put it, Celsius was not a bank. It was a house of cards built on false promises. For most victims, the Celsius collapse wasn't just financial, it was emotional. People lost college funds, retirement savings, and years of hard-earned trust in crypto. Online forums were filled with desperate messages. "I can't pay my bills. My life savings are gone. What do I tell my kids?" Celsius had sold itself as a movement, a community. But when it fell apart, its users were left to deal with the consequences alone. In bankruptcy court, Celsius claimed to be reorganizing to repay users, but most people will recover only a fraction of what they lost, if anything at all. The Celsius meltdown wasn't just a story about one company. It was a warning for the entire crypto industry. It showed how blind trust and flashy marketing can disguise massive risk. It proved that calling something decentralized doesn't make it safe. Other crypto firms soon followed the same path: Voyager, BlockFi, FTX, each collapsing for similar reasons: over-leverage, poor risk management, and greed. Celsius was one of the first dominoes to fall, and its collapse set the stage for the crypto winter that followed. But perhaps the most dangerous thing was how normal it all felt. The company's app looked friendly. Its ads featured happy users earning rewards. It didn't look like a scam. And that's exactly why it worked. So, what can we learn from the rise and fall of Celsius? First, high returns always come with high risk. If someone promises double-digit interest with no downside, that's a red flag. Second, trust is not a substitute for transparency. Celsius told users to trust the system, but never showed how it actually made money. Third, regulation matters. Crypto was built on the idea of freedom, but without oversight, freedom can easily become chaos. And finally, greed blinds even the smartest people. Many who lost money with Celsius weren't naive. They simply let their desire for quick profits silence their doubts. Celsius started with a powerful idea. That technology could free people from banks and give them control of their money. But in the end, it became the very thing it claimed to replace, a system built on trust, secrecy, and false promises. The Celsius collapse wasn't just a financial disaster, it was a reminder that innovation without responsibility is a dangerous mix. In the words of one investor who lost everything, they said, "Unbank yourself." But what they really meant was, trust us instead. And for hundreds of thousands of people, that trust cost everything. Thanks for watching this deep dive into the rise and fall of Celsius. If you found it helpful, give it a like and subscribe for more financial deep dives.